A consistent pattern emerges across every financial downturn over the past 100 years. The Great Depression, which obliterated 89% of equity value, the 1970s stagflation, which severely damaged bonds and savings, the 2008 financial meltdown, which erased $10 trillion, the COVID-induced market collapse, which plunged by 35% within 3 weeks, and the 2022 bear market, which decimated growth-oriented equities by 70%. These were 5 entirely distinct crises: a depression, inflation, a financial collapse, a pandemic, and an interest rate shock. Yet 3 specific positions endured through all of them. Not 4 distinct positions, nor 10 varied approaches. Precisely the same 3 strategies that proved effective in 1929, worked in 1973, succeeded in 2008, were beneficial in 2020, and again in 2022. Warren Buffett currently allocates 30% of Berkshire Hathaway's investment holdings to the first position. Right now, central banks globally are acquiring the second position at the most rapid pace in 70 years. Moreover, despite every crisis, every market downturn, and every wave of panic, the third position has consistently generated 10% annual returns for an entire century without interruption. These are not intricate strategies. They are not exotic financial instruments. They are 3 fundamental positions that any individual can maintain, yet most people neglect them. Instead, they pursue rapid gains, invest in popular trends, panic during market crashes, and ultimately lose everything because they fail to comprehend the underlying pattern. This pattern dictates that irrespective of the impending crisis, be it depression or inflation, a market crash or a pandemic, war or peace, 3 distinct positions will survive. They safeguard wealth, compound over extended periods, and enable investors to acquire assets when everyone else is compelled to divest. Allow me to illustrate precisely what these 3 positions are, how they performed throughout 5 entirely different crises, and why, currently in 2025, the world's most astute investors are strategically positioned in these exact 3 assets. Grasping this pattern bestows upon you something most investors never achieve: certainty. Not certainty regarding the nature of the next crisis, but certainty that, whatever crisis materializes, you will navigate it successfully. Before I reveal these 3 positions, it is crucial to understand their specific number. Why 3? Why not a single secure holding? Why not 10 diverse holdings for every conceivable scenario? The explanation lies in the financial market's 3 core economic conditions, with each of the 3 positions addressing one of these states. State 1 is deflation or crisis, characterized by falling asset prices, where cash reigns supreme, providing the liquidity needed for survival and the capital to deploy at market bottoms. State 2 is inflation or currency debasement, where paper assets lose their purchasing power, necessitating hard assets that cannot be printed or devalued. State 3 is growth or recovery, when the economy expands and productive assets compound, requiring ownership in enterprises that generate tangible earnings. Every historical crisis aligns with one of these 3 states or transitions between them. The Great Depression exemplified State 1, a deflationary collapse. The 1970s represented State 2, inflationary destruction. 2008 began as State 1, then transitioned to State 2 when the Federal Reserve engaged in extensive printing. COVID was State 1 for 3 weeks, then quickly became State 2 as stimulus measures were implemented. 2022 marked a transition from State 2 back towards State 1. By holding all 3 positions, you are protected regardless of the prevailing state or any impending transition. The first position offers protection during inflation. The second position also safeguards against inflation. The third position captures long-term growth. Collectively, they constitute what Ray Dalio terms the all-weather portfolio, not because it achieves optimal performance in every environment, but because it ensures survival through every environment. And survival is paramount, because the investors who endure market crashes are those who possess capital to deploy at the troughs, and acquiring assets at the bottom. That is where generational wealth is forged. However, one can only buy at the bottom if they survive the downturn. The 3 positions guarantee survival. Let me demonstrate their efficacy through 5 entirely distinct crises. The Great Depression, spanning 1929 to 1939, represented the ultimate deflationary collapse, the gravest economic catastrophe in modern history. Let us examine how the 3 positions performed. Position 1 comprised cash and treasury bills. In 1929, cash was backed by gold. The dollar was pegged at $20.67 per ounce of gold when the market crashed in October 1929. Equities declined by 89% from their zenith to their nadir by 1932. Yet cash did not diminish. A dollar in 1929 held greater value in 1932 because prices were falling. Deflation meant cash gained purchasing power. Investors who held cash persevered. They observed equity prices plummet, real estate values drop by 50%, and they waited. Then, in 1932 and 1933, when equities traded for less than the cash on corporate balance sheets and entire buildings were being sold for the cost of their lobbies, the cash holders acquired everything at fire sale prices. Bernard Baruch retained cash throughout the crash, deploying it in 1932 and 1933. By 1936, he was wealthier than before the downturn. Treasury bills, short-term government debt instruments, performed even more favorably. They yielded 3 to 4% interest while prices decreased by 25%, resulting in 28 to 30% in real returns. Cash and T-bills served as the ultimate deflationary hedge. Position 2 was gold. Gold was fixed at $20.67 per ounce until 1934, so holding gold ensured wealth preservation. However, gold became truly exceptional in 1934 when Franklin Roosevelt devalued the dollar. He reappraised gold from $20.67 to $35 per ounce. Overnight, anyone holding gold witnessed a 69% increase in dollar terms. Your gold remained unchanged, but its dollar price surged. This illustrates why gold endures crises. Governments cannot devalue gold. They can only devalue their currencies relative to gold. Investors who held gold throughout the Depression preserved wealth during the crash and accumulated wealth during the devaluation. Position 3 encompassed the S&P 500 or its equivalents. This is the contentious one because the S&P fell 89%. How did it survive? Through time. Horizon. If one had purchased the S&P in 1929 at its peak and retained it through the crash, by 1945, they would have recovered their initial investment, with dividends reinvested. By 1950, their money would have doubled. By 1960, it would have quintupled. The Depression persisted for 10 years, but the subsequent rebound spanned 30. Investors who held the S&P through the Depression and into the recovery generated generational wealth, not by perfectly timing the bottom, but by owning American businesses for the long term. Thus, 3 positions: cash, preserved capital, and facilitated acquisitions at the bottom. Gold preserved wealth and appreciated during devaluation. And the S&P compounded for those who maintained their holdings through the recovery. Collectively, these 3 positions enabled survival and prosperity during the worst crisis in history. The 1970s stagflation, from 1973 to 1982, presented the antithesis of the Depression: not deflation, but inflation; not falling prices, but escalating prices. This period proved fatal for most traditional portfolios. Let us examine how the 3 positions performed. Position 1. Cash and Treasury bills. During the 1970s, cash was a losing asset in nominal terms due to annual inflation rates of 7 to 13%. However, Treasury bill rates adjusted, rising to match inflation, eventually reaching 15% by 1981. If one held short-term T-bills and continuously rolled them over, they matched inflation. While not becoming rich, they avoided the destruction faced by bondholders. Long-term bonds declined by 50% in real terms during the 1970s because they yielded 3 to 5%, while inflation stood at 10%. Yet T-bills consistently adjusted higher, preserving capital. Position 2. Gold. This era unequivocally demonstrated gold's role as an inflation hedge. Gold commenced the 1970s at $35 per ounce. When Nixon closed the gold window in 1971, gold prices began to ascend. By 1974, gold stood at $200. By 1978, $300. By January 1980, it reached $850 per ounce, a 24-fold increase within a single decade. Anyone who allocated 10% of their holdings to gold observed that allocation expand to 50% of their portfolio by 1980. Gold did not merely preserve wealth during inflation, it multiplied it. This is why the second position exists. When governments print money, when inflation runs rampant, gold serves as the ultimate store of value. Position 3. The S&P 500. Equities struggled in real terms during the 1970s. The S&P remained stagnant from 1968 to 1982, enduring 14 years of flat performance. However, with dividends reinvested, one still generated 5 to 6% annually. While this was below inflation, resulting in a loss of purchasing power, one still survived. And here is the crucial point. In 1982, when inflation finally broke and Paul Volcker raised interest rates to 20%, when the economy entered a recession and widespread fear prevailed, stocks bottomed. From 1982 to 2000, the S&P yielded 17% annually, marking the greatest bull market in history. The investors who held the S&P through the 1970s participated in that boom. They did not accumulate significant wealth in the 1970s, but they positioned themselves for the 1980s and 1990s. 3 positions. T-bills continuously adjusted to inflation, preserving capital. Gold exploded 24-fold during inflation, and the S&P survived, positioning investors for the subsequent bull market. Together, they ensured survival through the opposing crisis. Deflation in the 1930s, inflation in the 1970s. The same 3 positions, a different mix of performance, but both times yielding survival and eventual prosperity. The 2008 financial crisis, from September 2007 to March 2009, was the second worst financial crisis in history, with the entire banking system teetering on the brink of collapse. Let us examine how the 3 positions performed. Position 1. Cash and Treasury bills. When Lehman Brothers failed in September 2008, when AIG received a bailout, when the financial system was hours away from complete collapse, cash was the sole asset that truly mattered. Liquidity vanished, credit markets froze, but cash functioned. Treasury bills became the ultimate safe haven. The yield on 3-month T-bills plummeted to 0 because everyone was acquiring them for safety, not for returns. Warren Buffett maintained $40 billion in cash entering the crisis. That cash enabled him to make his legendary investments: $5 billion in Goldman Sachs in September 2008, $3 billion in GE, and $5 billion in Bank of America in 2011. Those investments, made with cash held before the crisis, generated tens of billions for Berkshire Hathaway. Cash in a crisis is not about returns, it is about optionality, the capacity to act when all others are paralyzed. Position 2. Gold. Gold began 2008 at $850 per ounce. During the initial market crash in September and October 2008, gold fell to $700 as investors liquidated everything for cash. But then the Federal Reserve intervened with quantitative easing, infusing $1.5 trillion. Gold prices reversed. Position 3. The S&P 500. The S&P plummeted 57% from October 2007 to March 2009, a brutal decline. Anyone holding equities lost more than half their paper wealth. However, here is the repeating pattern. If one held through the bottom, the S&P reclaimed all losses by March 2013, a span of 4 years, and then continued its ascent. From March 2009 to February 2020, the S&P produced 400% in returns, marking the greatest bull market since the 1990s. The investors who held the S&P, who did not sell at the bottom, who reinvested dividends, generated generational wealth. $100,000 invested in 2009 had transformed into $500,000 by 2020. 3 positions. Cash facilitated deployment at the bottom. Gold captured the Federal Reserve's inflationary response, and the S&P compounded for a decade. Together, they provided not just survival, but prosperity. COVID 2020, from February to March 2020, represented the fastest market crash in history. The S&P declined 35% over 3 weeks. Let us examine how the 3 positions performed. Position 1. Cash and Treasury bills. Cash was once again the ultimate asset during the crash. When markets dropped 10% in a single day, when circuit breakers halted trading, when widespread panic gripped everyone, cash provided optionality. Bill Ackman maintained cash before the crash. He acquired $27 million in credit default swaps, which yielded $2.6 billion. He immediately deployed that cash into equities at crash prices, purchasing Starbucks, Hilton, Lowe's, and Chipotle, all at 40 to 50% reductions. Within 4 months, those holdings had doubled. Cash during the crash afforded the greatest rapid deployment opportunity in modern history. Position 2. Gold. Gold began 2020 at $1,550 per ounce. During the initial panic in March, gold fell to $1,450 as everything was sold for liquidity. However, by August 2020, gold reached $2,070, a 42% appreciation from its troughs in 5 months. The Federal Reserve had injected $4 trillion. The government distributed stimulus checks, and inflation was looming. Gold anticipated it. Anyone holding gold preserved wealth during the crash and accumulated wealth during the recovery. Position 3. The S&P 500. The S&P declined from 3,400 in February to 2,200 in March, a 35% decline over 23 trading days. Yet the recovery was even swifter. 3 positions: cash for deployment, gold for the inflationary response, and the S&P for the recovery. The same pattern, compressed into 1 year instead of 10. The 2022 bear market, from January to October 2022, was a different kind of crisis. Not a deflationary crash, nor an inflationary spiral, but a transition, the Federal Reserve raising rates to combat inflation. Let us examine how the 3 positions performed. Position 1, cash and treasury bills. This is where the first position truly excelled. T-bill yields shifted from 0 in January 2022 to 5% by December 2022. For the first time in 15 years, cash generated a real return. And while equities declined and bonds plummeted, T-bills gained value. If one had transitioned to T-bills in January 2022, they would have earned 5% that year, whereas the S&P declined 18%, representing a 23% outperformance. Cash preserved capital and provided income. Position 2. Gold. Gold struggled in 2022. It commenced the year at $800 per ounce and concluded at $750, marking a 3% loss. Why? Because rising interest rates render non-yielding assets like gold less appealing. However, gold did not crash. It did not plunge 50% as bonds had. It preserved most of its value. And in 2023, gold began its ascent once more, reaching $2,300 by mid-2024. Gold's role in 2022 was not appreciation, it was preservation. Position 3, the S&P 500. The S&P decreased 18% in 2022. Growth-oriented equities plummeted 30 to 70%. Technology stocks were severely impacted. However, dividend-paying stocks within the S&P fared better. Utilities, healthcare, and consumer staples only fell 5 to 10%. And in 2023, the S&P surged upward by 25%. Anyone who held through 2022 captured the 2023 recovery. 3 positions. T-bills yielded 5% and preserved capital. Gold preserved wealth without crashing, and the S&P fell but recovered rapidly. Collectively, the 3-position portfolio declined perhaps 5% in 2022, while the majority of portfolios dropped 20 to 30%. Relative outperformance achieved through diversification. 5 entirely distinct crises: the Great Depression, a deflationary collapse, the 1970s, inflationary destruction, 2008, financial system failure, COVID, a pandemic and stimulus response, and the 2022 rate shock. 5 different crises, yet 3 positions endured through all of them. Not flawlessly, not without volatility, but they survived. And survival, combined with time, culminates in compound wealth. Now allow me to explain why these 3 specific positions. What renders them unique? Why do they function across every crisis? Position 1 is cash and treasury bills. Why cash survives every crisis. Cash represents optionality. It is the capacity to act when others cannot. When markets plummet 30, 40, 50%, when assets are available at a discount, when everyone else is compelled to sell or is paralyzed by panic, cash empowers you to buy. Warren Buffett states that his preferred holding period is forever, but his second favorite is cash during a crisis, because cash in a crisis becomes the most valuable asset, not due to appreciation, but because it enables decisive action. Treasury bills are subtly different. They are cash that generates interest. Their yield adjusts to prevailing market conditions. When inflation is elevated, T-bill yields rise. When deflation occurs, T-bills preserve value. They represent the most liquid, safest asset globally, backed by the U.S. government, which possesses the ability to print dollars to repay them. This makes T-bills the ultimate defensive holding. How much should one hold? It depends on individual age and risk tolerance. However, here is the pattern observed among the most astute investors. Warren Buffett at Berkshire Hathaway currently maintains $325 billion in cash and treasury bills. Ray Dalio recommends 5 to 10% during typical periods, increasing to 30 to 40% when valuations are exceptionally high. The objective is not to maximize returns, but to possess dry powder capital to deploy when opportune moments arise, and opportunities invariably arise when markets crash. Position 2 is physical gold. Why gold survives every crisis. Gold is the sole asset with 5,000 years of monetary history. Empires have emerged and collapsed, currencies have been created and destroyed, yet gold has consistently maintained its value throughout. Why? Because gold possesses unique attributes. It cannot be printed. It cannot be digitally created. It necessitates physical mining. Its supply is finite, and demand remains constant. When fiat currencies are debased through money printing, gold appreciates. When financial systems collapse, gold is universally accepted. When inflation runs rampant, gold preserves purchasing power. The 1970s unequivocally demonstrated this. Gold climbed from $35 to $850. The 2000s proved it again. Gold ascended from $250 in 2001 to $1,900 in 2011. And presently, gold is reaffirming its role, having reached $2,070 per ounce in 2024, marking all-time peaks. Why? Because central banks globally are acquiring gold at the most rapid pace since 1950. China, Russia, India, Turkey, and Poland are all accumulating. They perceive unsustainable debt, inevitable money printing, and are diversifying out of dollars into gold. How much should one hold? Ray Dalio recommends 5 to 10% of your investment portfolio in gold, not gold mining stocks, which are leveraged bets, but physical gold or gold ETFs like GLD that hold actual allocated gold. The purpose is not speculation, it is insurance. When fiat currencies devalue, when the Federal Reserve prints trillions, when debt becomes unsustainable and inflation accelerates, gold safeguards your purchasing power. Position 3 is the S&P 500 index. Why the S&P survives every crisis. The S&P 500 represents ownership in the 500 largest American corporations. Apple, Microsoft, Google, Amazon, Berkshire Hathaway, Johnson & Johnson, Visa, Procter & Gamble. These companies generate earnings, distribute dividends, innovate, and expand. Over the long term, the S&P 500 has generated 10% annualized returns for more than a century. Through the Great Depression, World War II, the 1970s stagflation, the 2000 tech crash, the 2008 financial crisis, and COVID, through every crisis, the S&P has recovered and attained new highs. Why? Because the S&P embodies the American economy, and the American economy has expanded for 250 years. Recessions occur, crashes happen, but over time, innovation, productivity, and population growth propel earnings higher, and elevated earnings drive stock prices higher. The investors who hold the S&P through crashes, who reinvest dividends, who do not panic sell, compound wealth at 10% annually. This doubles your capital every 7 years and quadruples it every 14 years. Over 30 years, a 10% return transforms $100,000 into $1.7 million. The crucial factor is time horizon. If you require the capital in 1 year, do not hold the S&P. It can decline 30% in any single year. But if your time horizon spans 10, 20, or 30 years, the S&P is the most effective long-term wealth compounding mechanism ever devised. Warren Buffett has stated that for most individuals, the S&P 500 index fund is the optimal investment they can make. Not stock picking, not market timing, but simply owning American businesses for the long term. How much should one hold? That depends on age. If you are 30 years of age, one could allocate 80 to 90% to the S&P because you have 30 years to recover from any downturns. If you are 60 years old, perhaps 40 to 50%, as you require greater stability. However, everyone should maintain some S&P exposure because over any 15-year span in history, the S&P has never delivered a negative return. It consistently recovers. It consistently reaches new highs. Position 3 is the growth engine that compounds wealth over time. 3 positions: cash for optionality and crisis deployment, gold for inflation protection and currency debasement insurance, and the S&P 500 for long-term growth and compounding. Collectively, they establish an all-weather portfolio that endures every crisis and compounds through every recovery. Now let me illustrate what is transpiring presently in 2025. The world's most astute investors are strategically positioned in these exact 3 assets, and their allocation reveals everything you need to comprehend about what lies ahead. Position 1. Cash and Treasury bills. Warren Buffett, at Berkshire Hathaway, is maintaining $325 billion in cash and Treasury bills. That constitutes 30% of Berkshire's comprehensive assets, representing the largest cash position in Berkshire's history. Buffett has been divesting equities to accumulate this cash. He reduced his Apple holding by 50%. He has been selling Bank of America. He is not acquiring new assets. In his 2024 shareholder letter, Buffett stated he cannot find anything attractively priced. Translation: everything is overvalued. Remain in cash, await the crash, then deploy. This mirrors the pattern Buffett followed before every major market downturn. In 2007, Berkshire possessed $40 billion in cash. The crash materialized in 2008. Buffett deployed. Goldman Sachs, Bank of America, GE, he made billions. In 2019, Berkshire maintained $120 billion in cash. COVID crashed markets in 2020. Buffett deployed. Now Berkshire holds $325 billion. The pattern suggests an impending crash, and Buffett is prepared. Position 2. Gold. Central banks globally acquired over 1,000 tons of gold in 2022, exceeding 1,000 tons in 2023, and again surpassing 1,000 tons in 2024. This marks 3 consecutive years of 1,000-plus ton acquisitions, the highest 3-year total since central banks became net purchasers of gold in 2010. China's official gold reserves have escalated from 1,000 tons to over 2,000 tons, though analysts surmise China holds considerably more in unreported reserves. Russia liquidated U.S. Treasury holdings and acquired gold. Poland doubled its gold reserves. Singapore, Turkey, and India are all accumulating. Why? Because they perceive the same dynamics as billionaire investors. The United States carries $36 trillion in debt. The Federal Reserve will inevitably have to print money to manage that debt. Printing money devalues the dollar. Gold offers protection against that devaluation. These central banks are executing the second position at a massive scale, and billionaire investors are emulating them. Ray Dalio allocates 5 to 10% of his portfolio to gold. Paul Tudor Jones has disclosed gold holdings. Stanley Druckenmiller owns gold. The smart money is in the second position right now. Position 3, the S&P 500. Despite all concerns regarding crashes and bear markets, long-term investors are still maintaining their S&P holdings. Why? Because over time, it consistently recovers. And right now, the S&P is at 6,000 plus, nearing all-time peaks. But here's the key. Long-term investors are not selling. They are holding because they understand that attempting to time the market is nearly impossible. The optimal strategy is to hold through volatility and acquire more during market crashes. Warren Buffett holds Apple, Coca-Cola, American Express, and Bank of America. He is not divesting these holdings. He is simply not acquiring new ones because valuations are high. But he is maintaining the third position. Ray Dalio's all-weather fund holds significant S&P exposure. The smart money is not abandoning the third position. They are merely balancing it with the first and second positions. So, what course of action should you take? How should you strategically position yourself presently in 2025? Here is the actionable allocation based on the established pattern. If you are under 40 years of age, the recommended allocation is 20% in the first position, cash and treasury bills. This provides dry powder for when the inevitable crash materializes. 10% in the second position, physical gold or gold, ETFs. This safeguards against inflation and currency debasement. 70% in the third position, an S&P 500 index fund. You possess ample time to recover from any downturn, and you desire maximum exposure to long-term growth. If you are 40 to 60 years of age, a more balanced allocation is advised. 30% in the first position, cash and T-bills, offering greater protection as you approach retirement. 10% in the second position, gold. maintaining the same inflation protection. 60% in the third position, S&P 500, still providing substantial growth exposure, but with a more defensive posture. If you are exceeding 60 years of age, a conservative allocation is recommended. 40% in the first position, cash and T-bills. You require stability and cannot afford to forfeit 50% right before retirement. 10% in the second position, gold, as inflation protection remains crucial. 50% in the third position, S&P 500, still offering meaningful growth exposure but balanced with safety. These are the three position allocations that have proven effective through every crisis. They are not exhilarating. They do not promise 1,000% returns. They promise survival, preservation, and long-term compounding. And that is what constructs wealth over decades. Here is how to implement this. For the first position, open a brokerage account and directly acquire treasury bills or utilize a money market fund that invests in T-bills. Current yields hover around 4 to 5%, representing a real return with zero risk. For the second position, purchase physical gold from a reputable dealer or acquire GLD, the largest gold ETF, or IAU. Ensure it is allocated gold, not paper gold. You desire actual physical gold backing your position. For the third position, buy SPY, VO, or IVV. These are S&P 500 index ETFs that precisely track the S&P. Establish automatic monthly purchases. Employ dollar-cost averaging into the position. Do not attempt to time the market, simply accumulate consistently. This is not financial advice. I am not a financial advisor. This constitutes pattern recognition based on historical data. You should consult with a qualified financial professional before making any investment decisions. However, the pattern is undeniable. 5 crises, 3 positions. They endured all of them. 5 entirely distinct crises spanning 100 years. The Great Depression devastated equity wealth, but cash and gold survived. The 1970s stagflation destroyed bonds, but gold exploded and T-bills adjusted. The 2008 financial crisis crashed equities, but cash facilitated deployment and gold captured the Federal Reserve's response. COVID crashed everything for 3 weeks, then stimulus propelled recovery. 2022 crippled growth stocks, but T-bills yielded 5% and preserved capital. Throughout all of it, 3 positions survived: cash and treasury bills for optionality and deflation protection, physical gold for inflation protection and currency debasement insurance, and the S&P 500 for long-term growth and compounding. Not 4 positions, nor 10 strategies. 3. Simple, stress-tested, and proven across a century of crises. And right now, in 2025, the world's most astute investors are strategically positioned in these exact 3 assets. Warren Buffett maintaining $325 billion in cash. Central banks acquiring over 1,000 tons of gold annually. Long-term investors holding the S&P despite volatility. The pattern is reoccurring. The positioning is clear. The only question is whether you will recognize the pattern and position accordingly, or whether you will pursue rapid gains, maintain concentrated bets, and panic during the next crisis, forfeiting wealth you could have safeguarded. Most people will disregard this. They will believe they can perfectly time the market. They will believe their stock picks will outperform. They will believe the next crash will not impact them, and they will forfeit 30, 40, or 50% when the crash materializes. But a small group will discern the pattern. They will position themselves in the 3 assets that endure everything. And when the crash arrives, they will preserve capital, maintain purchasing power, and possess dry powder to deploy at the bottom. Then they will compound their wealth for the next decade, while everyone else is recovering losses. The 3 positions are not glamorous. They are not promising 10-fold returns next year. They are promising survival through any crisis and 10% compound returns over decades. That transforms $100,000 into $1.7 million across 30 years. That is generational wealth built through pattern recognition and discipline. If this video revealed a pattern you had never observed before, if you now comprehend that 3 simple positions have endured every crisis in 100 years, subscribe to this channel, because the next crisis is coming. It always is. And when it comes, you will want to be positioned in the 3 assets that survive everything. Not panicking, not selling at the bottom, but surviving and thriving while everyone else learns the pattern the hard way. This is not financial advice. This is pattern recognition. 5 crises, 3 positions, a century of proof.